Thanks, Michael. So as Michael mentioned, I am a fund manager at Firebird Management. Firebird is best known for investing in Eastern Europe, and that's the side of the business that I'm going to talk about today. We've been investing in Eastern Europe for a little over 25 years. We celebrated the anniversary earlier this year. And within that time period, we saw the region go from cheap on asset value basis. So when you talk about Russia and the voucher privatizations, when we started the business, the whole Russia was valued at $7 billion. To now, the region is cheap, not just on the asset basis, but also cheap on the earnings basis as well. So we're investing in the region with average PE for the index right now at around 6 PEs, which we find extremely attractive. And there's been a lot of positive changes in the region. Last year, I presented the company Agora, which is a diversified Polish media company. A lot of good things happened. The stock price didn't move that much. Happy to take any questions about it if you're interested. But today I'm going to talk about what we call like the corporate governance revolution in Eastern Europe, something that we've seen, the changes that we've seen over the last 25 years that not necessarily apparent to people who don't do this on a day-to-day basis. So I'm going to ask for a little bit of audience participation. One of these quotes is from an Eastern European company, one from a developed world company. So the first company says, we remain focused on driving our industry-leading growth projects forward on the disciplined capital allocation process in order to grow our business. The second company talks about really transforming production into dividends, and dividends remain the first priority and capital allocation before any growth spend. So if you think that the quote, where's my clicker? So if this quote is from a Western company, can you raise your hand? Okay. And if you think this quote is from a Western company? Okay. So it looks like, well, it's actually, so this quote, oops. So this is a Russian gold company. The company on the left is a US gold company, and they don't just talk about it. So you can see the companies that talk about dividends, they talk about returns on capital, they actually do what they say they're gonna do. So this is the company, one of the big, that has the highest return on capital out of the major gold companies around the world. Another example from a different sector, we have company says, we effectively convert our EBITDA into free cash flow and committed to our approach to have smart CapEx with higher than 20% returns. And another company says, we're investing in operational excellence, investing in technology, investing in innovation that aligned with these critical success factors that we mentioned. We're moving up the talent curve and moving down the cost curve, and then winning the attractive markets, we got to take share. So which company would you rather own? The one on the left? Or the one on the right? So the one on the left, just a couple. The one on the right, nope. Yeah. We like the one. Yeah, so we like the one on the left as well. It's a Russian steel company that doesn't just talk about capital allocation, they practice it. They do returns on invested capital of over 20%. The dividend yield on it is over 10%. They pay you a quarterly dividend. The company on the right is US Steel, and so you can see once again, returns on invested capital in Eastern Europe, in a lot of companies that we're buying are much, much higher, and these returns are being distributed to shareholders. We see that change. So one of the examples that we give is that back in 2002, 2003, Russian stock market was valued around PE of 5. And the dividend yield was 1.5. So you had a lot of earnings, but you wasn't really sure what was happening to those earnings. They were either being spent on some projects that were not necessarily high capital returns, but you weren't getting that money. Today, the PE is 6. It's up a little bit over this year. The market is doing quite well. But the dividend yield of the Russian market is over 6%. So they're sharing their earnings. They understand what capital allocation is, they understand what it means to have minority shareholders, and they're treating us accordingly. Romania has even higher dividend yields. So we see this happening, not just in Russia, but we see that happening all over our region, all of these significant positive changes. So the question is, why did that happen? And there's a few reasons that and I pointed two things. Before 2008, there was a lot of money coming into the region from all over the world. You had banks buying subsidiaries, Western European banks buying subsidiaries in Eastern Europe, pumping capital into the market because the capital had higher returns on capital. As quickly as the capital came in 2008, they left because of the problems that the banks had on their own books in Western Europe and continued to be, so there's no more capital flowing from these banks. There's still some subsidiaries around, but there's no more capital flowing from Western European banks into their Eastern European subsidiaries. It's really more of the other way around. And the second thing is in 2014, there was a war between Russia and Ukraine that is still an ongoing conflict. But that was another, in 2014, what happened was a lot of people that started looking at the market because of the good valuations, they really pulled back because now you had political risk, you had sanction risk, and there's a lot of different things that were happening in the market that really made you uncomfortable with investing there. So we were in a position, our markets have been in positions of constant capital outflow for over 10 years at this point. It accelerated after 2014. So what happens, the companies have to learn how to be more capital efficient because they can't count on capital coming in from the outside. So, and that turned over time, we see that translate into better performances of the business. The other aspect is that good corporate governance, if you run your business cleanly, if you have established the asset cleanly, then it's less likely that somebody will go after this asset. So there's less likely that there's going to be a predation where some kind of unsavory actors will go after this asset because there's really nothing to catch on. You can't blackmail, you can't. It's much easier if you run the business cleanly, then you can continue running the business and running the business well. So one of the best examples of improved corporate governance and good corporate governance we find is in this company, Georgia Capital, which is the company I'm going to talk about today. Before I'm going to talk about Georgia Capital, I want to spend a little bit of time on Georgia, which is a country of 3.7 million people. It's in kind of the eastern side of Europe. And one of the distinguishing characteristics is that most of its neighbors hate each other. So Armenia and Turkey don't get along. Armenia and Azerbaijan don't get along. There's a lot of conflicts around the region. So while like the countries as a whole may not be particularly fans of each other, but the business people want to trade. And Georgia being the open economy that has free trade agreements with a lot of places, including EU and China, has become a natural hub for business activity in the region. And it's also a beautiful country. So coming to visit to Georgia as a tourism destination, the tourism numbers are growing constantly. And all of that is translating into a pretty good GDP growth. We see a GDP growth of 4 to 5% per annum in real terms, and closer to 8 to 10% per annum once the inflation is included in nominal numbers. Georgia has a really interesting history, and I think you have to understand where it is now in terms of how it got there. So the early post-Soviet period, that was not a good place to be. You're talking about separatism on the borders. You're talking about civil war. If you go to Tbilisi today, the capital, you still see the signs of those conflicts all over the place. If you go a couple of blocks of the main streets, you see buildings with bullet holes. And you have to understand, it was also like the most corrupt country, former Soviet Union, and that says something. So this was a country that was not a good place to be. Up until 2003, when this guy, Mikhail Saakashvili, came in with a mandate to change things. He got elected with over 90% approval rating. And he came in and with a mandate from the people to change things for the better. And one of the first things that he did is he proceeded to fire every single policeman in the country, because that was one of the roots of the corruption. And he then proceeded to say, okay, if you want your job back, you're welcome to have it back. You can apply for it, but things are going to be different from now on. We're not going to have corruption. We're making government as small as possible. He solved one of the separatist conflicts with Ajaria. The two other ones are still outstanding. But it became a much better place to do business. It went up dramatically in rankings of doing business and became a country where you can live. And the corruption has almost been eliminated as a result. And once you eliminate corruption, the people who used to live in a corrupt environment and they no longer have to, they really want to hold on to that. But the thing that he doesn't get any credit for, which is most important to the story of Georgia where it is today, is in 2012, and he kind of had this like benevolent strongman approach to running the country. In 2012, they had an election, and there was election night when it was really close, where it wasn't quite certain whether he lost or not. And what he did is, because he knew that if he tries to hold on to power in a way that's in any way doubtful, it's going to kind of really throw the country back into where it was before. So he just left. He said, I lost, I left, and he left the country. And the new people who came in, they continued to run the country, like the same fundamentals that were built up during the Saakashvili years, they continue to be there from a point of view of the free, open economy. If you could, this is still a great place to do business. But there's no longer that stigma that came with Saakashvili years and the strong, and the strongman that he was. So right now, if you go to Georgia, Georgia is a really good place to be. I have some pictures. This building on the left, bottom left, this is a police station in Georgia. Every single police station in Georgia is made out of glass. The reason why it's made out of glass is to show that people are watching them. You're not watching us, we're watching you. And that way, that's one of the ways that the country continues to say we're not going to have corruption. The building on the top right is this is a building in Tbilisi. There's one in every major city. This is called the Government Services Building. Anything that you want to do in Georgia that has to do with the government can be done within a building like that. Pay your utility bills, renew your license, whatever you need to do. All in one place, once again, reducing opportunity for corruption. The other two pictures are just nice tourism photos to encourage you to go. Georgia Capital is a company that was listed last year in London. It was spun out from a bank, Bank of Georgia. This was a collection of assets they've built up over the years by investing in other non-banking businesses. They decided to spin it out as a separate company because it was becoming a little too complicated as part of the bank. And today it has a market cap of around 450 million and trades 1 million per day. And this is a fully listed company in London. It gives you exposure to almost every segment of Georgian economy that matters. We're talking, they still have a shareholding in the bank that's spun it out. They have a majority share of a healthcare company that is also listed in London. And they also participate in utilities, wine and beverages, hotels, housing, education, you name it. They're probably involved in it if it matters. So by buying Georgia Capital, you get an exposure to the strong, vibrant economy, and I'm going to make a case that you're buying it at a very good price. But one of the most important things about Georgia Capital is their management and how good of a managers they are and the track record that they have. So the person running Georgia Capital right now is this guy, Irakli Gilauri, who was CEO of the bank from 2006 to 2018 up until the spinoff. And then he decided instead of staying in a larger bank, he said, I'm going to go work, I'm going to lead Georgia Capital, which is always a good sign in case of a spinoff. If you see the CEO going towards the smaller company, that's one of the things that we look for. As the CEO of the bank, he did pretty well. Bank's net income grew by 18 times within 12 years that he was there. Book value CAGR was 17%. And he has a lot of skin in the game. So he owns personally 2.5% of the company. And both him and all of the top management gets paid primarily in shares of Georgia Capital. So they have continuous incentive for the share price to do well, and they're very much aligned with us as shareholders. It's not just Irakli, they have a very strong management team. A large part of the bank's management teams went into this business. They like being in this business because it gives them exposure to many different sectors, and the young people, when they go to work for Georgia Capital, they know that they can work at the bank, they can, no more at the bank, but they can work at the healthcare company, they can go work at the utility company, and they get to try a lot of different things until they find their home. And there's a lot of opportunities for advancement within that. They have a very strong record in pretty much almost everything that they've done. The housing development that they've done in the past has IRRs of over 75%. Georgian Healthcare Group, the company that they still own control of, this was a company that was built up. They used to have an insurance division, healthcare insurance division. Then they realized, okay, the money is not on the payer side, it's on the provider side. So we're going to invest a lot of money into building up a strong healthcare company with hospitals, clinics, pharmacies, etc. They've tripled their EBITDA in just 3 years and continues to do really well. And everything that they've touched, as I mentioned, does really, really well. One of the most important things about them is their capital allocation. So they're saying that this is what they're saying is their key competency. They focus on capital allocation and everything that they do. One of the criteria that they have is that, okay, we have our own share price, and we're going to compare any capital that we're going to allocate to where our shares are trading. And if we have free capital and our shares make more sense, we're going to buy back shares. In just a little over a year since listing last May, they already bought back 11% of their shares outstanding. So that kind of shows that they believe that the value in the shares is there. And meanwhile, a lot of the capital they're going to be deploying over the next 2 years, they don't need to issue any more shares. They're going to be deploying capital that's coming in from the businesses that are already developed. Their current NAV is about 50 lari per share. About half of it comes from the 2 listed companies, so you can track exactly where it is. And they give you a lot of disclosure of how they come up with the NAV of the rest of the businesses. If you look at their disclosures, this is a very open company. They explain to you the multiples that they use. So, the important thing that this NAV is growing. The company is cheap. Not just the company itself is cheap because it's trading at a discount to NAV, but also every piece of it, if you look at it separately, is cheap. Bank of Georgia, which is listed in London, is trading around 6p and 6% dividend yield, which is a bank that gives you 20 plus ROEs per year, grows at 10% plus per year, and pays you a 6% dividend yield. We own the bank directly. We think it's extremely attractive. Georgia Healthcare Group, same idea. This is a company that's trading at I think 6 or 7 EV to EBITDA, where the other healthcare companies in emerging markets are trading at double-digit numbers. So this is discount on top of discount on top of discount from a point of view of what you're getting here. And once again, the key here is the capital allocation and the capital allocation opportunities that they have coming up. They're building up a lot of renewable energy, they're building up hotels, they have a lot of places where they can deploy capital. This is a company with 450 million market cap today. They plan to deploy over $750 million into various projects in various sectors over the next 4 years. And a lot of that money, like once again, a lot of it is going to be debt funded. They do not need to issue any more shares for these projects. And if you buy in at a 12% yield today, then by 2023, once all of these projects are online, a lot of them have return ROICs of double-digit ROICs on unlevered basis. So on levered basis, you're talking 30-40%. You're going to get to a free cash flow yield to today's price of 34% just in the next few years. Aside from reinvesting in the existing businesses, what they also have is they have platforms for acquisitions in various sectors, like beverages, where they're able to buy smaller wine and beer producers in the country and consolidate them into the sectors what they have. They're doing a similar thing in education. They just made the first acquisition in automotive services. They made the first acquisition in digital marketing. So what they're saying is that we have access to cheaper capital. We're able to deploy it in better ways than what a lot of you guys can. So we are going to be very opportunistic. If we see a good opportunity to buy, we're going to buy. If we're going to see a better opportunity in our shares, we're going to buy shares. But meanwhile, we have all of these different projects that we have to spend money on. Putting all of this together, we have a current NAV of 50 GEL per share, and it's trading at about 25% discount to that. By 2024, the NAV should be over 200 GEL per share. So it should quadruple, which gives you a CAGR of about 35%. We have no view of where the discount should be. I mean, if you look at where the holding companies trade, 25% usually sounds about right. We think that these guys are really good capital allocators, but you could say the same thing about Exor or any other company. And it's not like those companies trade at a premium to their sum of the parts. But we do think that 25% discount is about right. But meanwhile, you can get a very good CAGR in this company from the way that they reinvest capital over the next few years. So I think that's about it, and I have 2 minutes left. Thank you very much.
So do we have some questions about the idea? Yeah.
Isn't China active in that market?
They have so China and Georgia have a free trade agreement, which just came up, was signed just a couple of years ago. The country is, to be honest with you, too small for China. So when Chinese want to deploy capital, they have $1 billion to deploy. In Georgia, it's a country of 3.5 million people. You really can't spend that amount of money in one particular thing. And to do what these guys are doing, where you spend 20 million here, 30 million there, 50 million there, most of the people from China are just simply not going to bother. But the relationship with China, because of the free trade agreement, is important. So what people are doing is they're setting up manufacturing. For example, Israeli people from Israel setting up manufacturing in Georgia to sell to China. So the free trade agreement makes a lot of sense. It's important. But meanwhile, they're not competing with people from China for the assets that they're buying.
Any other questions?
Yeah, I see that you project very high returns, but I guess that many of them are nominal terms, right? So what is is this the catch? Is this what is the inflation in Georgia?
So the inflation in Georgia right now is around 5%.
5%. Okay.
Yeah, and so to the other point of what you're asking is what happens to the currency, because this is the returns in local currency, and the currency has been weakening about 3 to 4% on average. That kind of reflects in the inflation. We think that right now, for a number of reasons, the currency is cheaper than it should be, so it's a good time to buy lari earning assets if you have to. But the important thing that a lot of the investments that they're doing, so I have a couple of slides here on renewable energy. So these are like returns on invested capital based on PPAs and dollar terms with the government. So like, for example, so these returns are dollar based. And that's where they're going to be spending a lot of the money that they have to deploy. So from this point of view, I don't think they're assuming any kind of lari changes when they're putting in their numbers, but you're protected here. You're protected in a lot of the other places how they earn their money.
Any other questions? Can I maybe ask one question then? The discount to NAV is 25%. Is that like the look-through discount? Because you also have discount on the listed companies, which you calculated, or is this just based on the market value of these firms?
So half of where's this slide? So half of the NAV is the listed companies, and that's on that's where these companies are trading. Yeah. Whenever I made the slide a couple of weeks ago, the other half is what they estimate the value of their holdings to be, which if it's sorry, if it was recently acquired, it's based on acquisition price, or if it's most of it is an earnings multiple. So this is not, so the discount is to that value, not to what we think the fair value of these things is.
Okay, so that would be an even greater discount.
I would agree with that.
Okay, well, thank you very much.
Thank you.